Hello and welcome to the Q1 2020 CFG Market Update. We have a ton to cover, so I am just going to kind of roll through this thing pretty quickly so you guys have a good idea on what we see in global markets and how we're positioned moving forward. Before I jump into that stuff, I just wanted to give you a heads up that we are jumping into the live streaming space. We are going to start a YouTube live every single Thursday, starting next Thursday. It's kind of cool. What we're going to do is I'm going to discuss what's going on in global markets in real time on Monday through Thursday morning. If you have any questions at all about anything, go ahead and send it in to info@cfgfinancialplanning.com. We're going to sift through those and I'm going to answer those questions real time. We'll see how efficient it is, but we've gotten great feedback from other people that have utilized these strategies, and we just think it might give you guys an opportunity to interact with us a little bit in real time and ask those burning questions, and I can answer them for the benefit of all. So without further ado, let's get into things here. Wow, folks are bullish again, aren't they? All over TV. All the big wirehouses, everybody's saying the same thing. Oh man, we're going to come out of this thing with a V-shaped bottom. It's going to be incredible. I got to be honest with you guys. The data's telling me a different story. I'd love to be bullish. And at some point, I'm going to be bullish again, assuming the data tells me I can be bullish. Let's take a look at this coronavirus chart. It looks an awful lot like the US chart, but this is actually the global case chart. This is the curve that everybody is talking about needing to get flattened. I'm not really sure where everybody's coming up with a bell curve per se, because all you can see really at this point is that the curve is starting to get less steep, which is good, but it's not rolling over, nor will it roll over at any point in the near future as we continue to see cases. I think the best example of this is going to be what's going on in South Korea. They are about a month ahead of us. They had a very, very impressive response in terms of shutting down their economy, their version of social distancing, their version of disinfecting things on a large scale. They also had much more efficient testing right from the get-go, and their curve is still going up. A month ahead of where we are currently. Realistically, if we slow the spread, as they say, we're going to be dealing with an increase in cases for months from now. Given the fact that more than half of small businesses don't even have 14 days of liquidity, this is going to be a problem. Even with the extreme helicopter money falling from the skies and the PPP loans and all of the specialized SBA lending and the $1,200 checks and everything. I mean, businesses are going to close and they're not going to reopen. There's just really no way around that. All we have to do is take a look at this chart. I mean, this is a liquidity scenario where a lot of these companies, they just can't win. More than 20% of the businesses don't have enough liquidity to get through a month, let alone 3 or 4 of a quarantine scenario. Small businesses contribute $5 trillion to US GDP. At least that's what it was last year. This, in and of itself, is a massive, massive problem. The stimulus that we were talking about a couple seconds ago, it's going to alleviate a portion of these issues, but companies are going to fail. We speculate that the restaurant industry is going to be among the hardest hit. The mom and pop shops just don't have the balance sheet or the logistical support to survive in a quasi-remote, touchless delivery, CDC regulated world. And if business liquidity weren't a big enough problem, the US consumer is even more ill prepared for this type of downturn. This chart shows a percentage of households that don't have a nickel of liquid savings. I mean, of course, they could put things on their credit cards or whatever, but we're talking savings that are easily and readily accessible. Obviously, the more mature a citizen is, the better his or her personal balance sheet is, but we're still talking about 50% of Americans with no savings. I have a hard time understanding how so many pundits can sit here and tell us that the market's priced in the worst case scenario when there's coordinated efforts for tenants not to pay the rent. And landlords can't evict anybody even if they don't pay their rent. Of course, I understand flexibility and why it's important in, paying insurance premiums and possibly being able to delay your mortgage payments. I mean, desperate times call for extreme measures, and good on these companies for being more flexible, but this is doing irreparable damage to the markets. With all that information in mind, let's take a look at consensus projections for GDP. This is pretty comical from my perspective. Just for the sake of argument, we're going to look at Goldman Sachs' 2020 GDP projection of a whopping 0.4%, wait for it, increase. Yeah, they're expecting GDP to be up year over year. I mean, I'm not sure where they're getting that. This chart is pretty telling. Maybe I missed something, but not a single one of these scenarios shows positive growth. I mean, that is a lot of red on the screen. Furthermore, when has there ever been a 2-month recession? Everybody's saying we're coming out of this thing. I mean, I think we're just getting started in terms of the financial strain. Now, granted, there has been more money thrown at the economy and more drastic measures taken in the last 3 weeks than in the cumulative history of fiscal and monetary stimulus. But we're still dealing with a market and an economy that is essentially closed for business, with the exception of e-commerce. The last domestic data point we're going to take a look at is we're going to talk about stock buybacks. This chart is interesting because when you think about stock buybacks, you normally would associate them with strong companies with good balance sheets that have a lot of free cash flow that are trying to create more value for their investors. But this chart it's really powerful. I mean, the buyback index in blue is getting crushed relative to the S&P 500. This is a direct result of not only sentiment, but the fact buybacks will be cut by a drastic rate over the coming quarters. And they've always acted as an easy way to improve earnings because they just take a hatchet to the denominator. This strategy has been thrust into the spotlight by politicians recently, and while politics have no place in investment strategy, they do pose headline risk. So even companies that are really strong and still have pretty good free cash flow are likely to at least halt or suspend their buyback plans just to avoid any political or media blowback. This is going to do two things over the short term. First, the companies themselves are not going to be stepping in supporting their own share prices. Secondly, this is going to create further volatility in the market and potential downside, as the largest segment of investors in stocks is actually the companies themselves. They actually buy more stock on average than institutions or retail investors. And they're going to be leaving the marketplace for the time being. Getting a quick update on foreign economies, I think we're just going to focus on the EU for this video. There's not much to report in terms of coordinated stimulus at this point in time. The individual countries have tried to do a little bit to get themselves back on track to help their citizens, but the EU is supposed to be one cohesive unit, and they do not have a full-blown stimulus plan from the ECB at this point. Madame Lagarde said she's going to do anything and everything necessary, but so far that's been not much. Recessions are everywhere in Europe. If you remember 3 to 4 months ago, we were talking about things getting less bad. Well, now they're back to getting more bad, kind of like everything else from an economic perspective. This pandemic is going to send almost all of Europe back a few years in their overall growth rates. This chart, I think, is telling because it was kind of showing how things were smoothing out at the bottom. Normally when you see that, there's going to be some sort of ramp in GDP growth. But I think that there's just simply going to be a demand issue here, and the social dynamics of Europe are such that it's going to take an awful lot to get people back to work and back to spending as usual. And there's those demographic issues that we've talked about in the past that are playing in here. Talking about the UK in particular, I think it's really important to point out how dangerous it is that Boris Johnson has spent some time in the hospital. I mean, thank the Lord that he's getting released, but it's probably highlighting some underlying health conditions from him, and I'm a little bit concerned on how much faith the Parliament's going to have in his leadership abilities moving forward. British politics are very, very fickle. And much more aggressive than our politics. So I hope he remains healthy and has the support he needs to get Brexit done. Otherwise, that's going to be very challenging for the UK economy. This time around, I think I'm going to go ahead and avoid discussing China. Things have been a little bit shady over there. Their accounting practices on some of their publicly traded companies have caused huge problems. They're kind of fudging with their PMI data, kind of fudging with their GDP data. At least it seems like that on the surface. Nobody really knows exactly what's going on. So we're going to give them a little time to get their act together before we start discussing their economy again in these missives. Last but certainly not least is the oil price war. Wow. Great timing. Thanks, Russia and Saudi Arabia. If you haven't read my article on that, it is on incrediblethoughtsnet. It discusses the whole oil price war thing. Most of the stuff I talked about in there has actually occurred. We've already started seeing bankruptcies here in the United States. Some of the small, more over-leveraged oil wildcatters are really, really struggling right now. President Trump has met with U.S. producers recently, and it looks like we are on the cusp of having a bona fide deal to cut some production. Also, Mexico is jumping on board. Granted, we're subsidizing them, but they're still going to help out. There has been a huge supply shock from Russia and Saudi Arabia turning on the spigots. And unfortunately, when looking at this chart right here, there has also been a demand shock with most of the global economy being essentially shut down. Our research suggests a slightly less aggressive rebound into 2021, but there should be ample opportunity for the strongest oil companies and the most nimble wildcatters out there to gain some market share and rebound accordingly. As such, this is going to be an area of focus for us moving into the summer months and possibly even into the fall. Our general positioning, as always, it's dictated specifically by the data. All discretionary portfolios are overweight cash. That shouldn't come as any surprise to anybody that's talked to me in the last month or so. U.S. equity and international equities are a smaller percentage of portfolios than they normally are. Some of that is just natural because there's been a decline in stock prices, and then we've also traded portfolios pretty aggressively through this and pared down our equity exposure as I continue to see volatility on the horizon. Fixed income is an overweight, partially due to the equity declines, but I haven't really rebalanced the fixed income positions because of my projections for additional volatility. They should provide us a little bit of stability in our portfolios. Individual stock accounts are carrying much more cash than usual, and we even have some short-term and ultra-short-term bond instruments as well. We've trimmed the portfolios down to mostly core holdings at this point, with very, very strong balance sheets, and almost all the speculative positions are gone. Remember, each portfolio is specifically designed for a client's needs and their individual risk tolerance, so the aforementioned allocations don't necessarily apply to everybody. Thank you all for taking the time to watch this video. We relish the opportunity to communicate our thought process to you, and we believe transparency is the most important aspect in our asset management strategy. It's important for you guys to know how we're positioned and why we're positioned. Thank you for trusting us. It means a lot, and we're doing our best, and we're working hard, and we're here for you. And if you guys would like to schedule a review, don't hesitate to reach out to our office. If you're not a client yet, you just want a second set of eyes on things, you can reach out to us at info@cfgfinancialplanning.com. Here's to a healthy, happy second quarter and beyond. Our thoughts and prayers are with those affected by this virus and the first responders that are so heroic protecting the least of us. Thanks for watching.